Evening, everyone. Welcome to Grip Presence Finfluence 2021, a digital conference driving interaction for investments by New Age India to commemorate our milestone of facilitating 100 crores of asset-backed investments. Big thank you to our panelists, Gaurav Gupta and Vaibhav Porwal. Gaurav is the business head for Cube Wealth, a digital platform for HNI investments as well as investments for professionals, and Vaibhav Porwal is the co-founder for Dezerv. Dezerv again is a new digital wealth application, and they are about to launch in the coming week, as far as I understand. So, welcome to both of you. Thank you so much. I believe between the both of them, we have a combined experience of over 30 years in the startup and wealth management space. So, looking forward to great insights from you guys. And how I would like to start about this topic today is that, we understand non-traditional investments, that is investments other than mutual funds, fixed deposits, stocks, were originally exclusively available only to HNIs and institutions, probably due to their unique characters or, an unconventional nature, or even if you go to see not enough public information that was available to them. But technology today has enabled these very products to, be available at a scale and widely, even to the retail investors. Additionally, I also feel that there was a need of diversification in the portfolio, which has also driven a fabulous growth in this particular space. Looking at global numbers, I believe the new age investments clocked around 13 billion last year, as per the data by CAIA, which was approximately 15% of the total global investments. And they estimate this number to grow to anywhere between 18 to 24% by 2025. India also has been at a very nascent stage, when it comes to this particular space. But it would be interesting to know your outlook, Vaibhav and Gaurav, as to where do you see these particular investments. And but before we dive into that, and before we get into a detailed discussion about how the new age technology is shaping up, I have one very important question, and that's something, quite personal to me as well, that are these non-traditional investments really non-traditional, or they are just a repackaged version of, what used to exist before? Vaibhav, would you like to get a take on it?
Yeah. Thanks. Congratulations, guys, on achieving 100 crores. It's a remarkable feat, and many more 100 crores to come your way. Uh, so on this non-traditional investing, I grew up in a business family, and for our family, most of the surplus liquidity was always invested in lending. So it was largely a community-based lending, and within our business circle and within our community, family used to lend money. So obviously, in some sense, we never treated that as an alternate form of investing, right? Along with that, a lot of large global houses treat gold as alternate investment, and gold is as mainstream as it can get in India, right? So, in some sense, most of these instruments have been there. The only difference that I see now is they become more mainstream now. Access to these opportunities is available across the board. All kind of investors can participate in them. These investments are available in smaller ticket sizes, so reach and size of the market has gone up significantly. Yeah, otherwise, most of these investments have been there for the longest period of time. We've seen families with large collection of art or large collection of antique jewelry. I've always heard many stories about them, right? So in that sense, it's not as new a concept as we make it out to be, but ability of distributing these products across a much wider audience is something which is a new advantage that we have today.
That's quite an interesting point that you make. At the last, the ability of distributing it to a wider audience, and I think I would like to ask Gaurav about it. That why was initially it not distributed to a wider audience, or what was the problem with adoption to a wider audience when it comes to these investment opportunities?
Yeah. So, it's almost like every industry waits for its turn, right? So, uh, if theoretically you give me, let's say, solid returns on debt, I might not invest in equities, right? So every time we take a decision, we start with the point of view of saying, what do we want in return? And it's not that we don't know the risk reward part of it. When in different terminologies, everybody know the risk reward part of it. So, for example, the way Weber was explaining, right? I mean, I grew up in a family which is a mixed bag of professionals as well as business. When I was explaining to my dad the concept of P2P for the first time, he started laughing on me and saying, "You know what? This has been happening for ages in the circuits, right?" And the rates he was telling me were mind-boggling. He said, "Why don't you put your money?" and and I started trying to figure out, it's great that but somebody like me who's sitting in Bombay or Bangalore or Pune, and I don't have people who would like, and like for example, my friends don't need the debt they are looking for sometimes, and for that matter, even if I give it to them, I don't think I can charge what they say up 10 paisa on a rupee or whatever, right? I really can't charge that, which means I am looking for a legitimate way to put that money, put that extra surplus, happy to take the risk, which I know, and I should be aware about the risk, which means I know for a fact that I am putting certain percentage of my debt portfolio. I'm also aware that there's a risk associated to it. So I do my mental maths of saying, what is the risk? What is the reward? Is it worth it? And I put the money accordingly. Now, why is it not available in the earlier days? As I mentioned, right, it's going to take some time. It takes its own shape. These kind of assets, and Vaibhav can tell you a lot more, right? They are available to ultra HNIs forever, right? It's not new for them at all, right? And indeed, for that matter, the largest firms around the globe are the alternative investment firms, right? The BlackRock or the KKR or the Carlyle Group. These they are all doing alternate only, right? They are just available to pension funds and the ultra HNI or these, the limited partners and all of that, right? It's you guys are doing a very interesting job of, I almost say, making it fractionalized, making it available to people like me, so that I can make it part of my portfolio.
No, absolutely. I think to add one point to that, and Gaurav spoke about risk and return. So a certain level of sophistication is required to understand the risk return dynamics of these asset classes. And therefore, it's important that people first develop familiarity with these instruments and then increase allocation to them.
Interesting points there, right? And Gaurav, thank you so much, and Vaibhav also on your insights. Just following up on that question as well, what do you think is India's appetite, let's say 4 to 5 years down the line when it comes to these kind of investments? Do you see enough appetite in the retail segment as well, as much as we've seen in the institutions or ultra HNI?
Oh, absolutely. India's appetite keeps surprising me. I met one of the largest AMCs in the country last week, and they said that they have less than 10 million folios, right? Whereas your Coin DCX said that they've crossed
Yeah.
10 million users. So don't talk about the appetite in India. There is an endless appetite. When we talk about absorption of these investment ideas, whether it is gold, whether it is art, whether it is stock. We just need to develop comfort and familiarity with these asset classes, and there's tremendous amount of appetite. We have 150 lakh crores worth of deposits with the banks. Market cap has touched $3 trillion plus. So even if we take global standard of 5 to 10% of these two numbers, you're talking about a crazy pool. So appetite is endless. People need to find them rewarding, and people need to get access to these opportunities in the right framework.
That's quite an interesting point. Gaurav, do you differ or do you have any additional view on that?
No, I 100%, I broadly agree to the ideas. And as Weber was saying, right, India is India keeps surprising us whenever we look at any specific trend, right? And you continue to do, on paper mathematics to figure out the Excel model of figuring out what could happen. And crypto is a great example, right? And approximately 2.5 crore accounts are there. Now, to think about the active demat accounts, which are around 3 crore, if I'm not wrong. Now, sure, 8-9 crores are total account, but active are just 3 crore. Now, you think about it, right? This is a This is something which has come after the regulation has been lifted off and so on and so forth. Now, see it's the important part to understand India as a country is that it's in certain pockets it's growing faster than our imagination, and it is happening because sure, imagine it's almost accessibility of information, right? And the cheap phones are available, the cheap data is available. People are smart, right? We underestimate people when it comes to it, and there have been hundreds of experiments done, right? You leave a laptop in a room full of illiterate people and they figure out how to run it, right? And same happens with, and the in different languages the content is available, they can consume, they can understand. And see, guys, understand that whatever we call alternate, and you started with that whole point, it's not alternate for them, it's for them it's usual. They have always been buying a, let's say, probably a bullock cart with taking on lease, for example, right? They've always been exchanging money. Now there is obviously a fundamental point around trust, because see, for them, when they've not seen it, there's a trust issue. But the good thing is the penetration of investments in general, broader sense, which is happening across the country, right? Not just in tier one, at least in some capacity or the other, increases the awareness. Now, once the awareness increases, people are okay to try out. Now, as Vaibhav, one of the point Vaibhav mentioned is very important. It's like they try out with smaller amounts, then they see how it works, and then they increase the allocation. And to be honest, that's how we also operate, right? And when they do, this is what we need to accept it as a fact.
I think it's a great point on trust, and it makes me wonder why people keep so much money with banks and LIC. It's nothing but trust, right?
Yep.
There is an implicit trust that government of India is there, or RBI is there, or in case of LIC in itself is a proxy of government of India. So trust
Yeah.
Yeah, I
a
think
very powerful factor in investing.
Yeah, no, 100%. I think trust is, I think, at the highest epitome, when it comes to investments. Also, when it comes to investments, trust is like you trust a person, you will only take his or her advice, or, only that select individuals. They are very, very necessary. Although they might not give you a product which gives you the highest return, but you will still trust them, because at the end of the day, wealth management, I believe, is much more of a preservation play and not a creation play. Correct me if you are wrong there. Sorry if I am wrong here.
No, thought process is changing. So now people are looking at wealth creation opportunities also. So all of us have heard enough stories about success of Warren Buffett or Rakesh Chunwala in India, and so many different stories are there. So people want to invest now and use investing as a tool to create wealth. So that's what I'm witnessing, and maybe it's a function of where markets are today, but I definitely see a significant shift in investors' orientation.
That's interesting. Just on that, do you see any particular demographic, as far as comes to adoption of these new age investment products, or you think that it's quite well spread, and it's necessary not a demography that we need to target, but everybody will be taking it up sooner or later?
So in my experience of dealing with investors, honestly, demography has never made any difference. It's investors' attributes and his perception of risk and his investment objectives that drives his decision making and selection of instrument. A 25-year-old guy can be conservative also and aggressive also, and a 60-year or 70-year-old guy can be as aggressive as any of us. I've seen people who are 75 or 80-year-old being super aggressive on equity, and their thought process, the corpus that they've accumulated over time is meant to be handed over to the next generation, and they want to create a very aggressive portfolio, whereas I found 25 years being extremely conservative. Depends on your perspective, your requirements, and your experience, right? So people who have seen wealth creation through investing in high risk asset classes are very comfortable with that. Someone who have had a bad experience tend to get really tentative about investing in these asset classes. So I don't think more than And I strongly believe that more than demographics, it's the investors' attributes and personality which are more relevant.
Wow, that's a very nice point, and I think I'm going to take that with me as well. That investors' attributes are very, very important. So, thank you so much for that, Vaibhav. Gaurav, how about you? What do you think about that?
Yeah. So broadly, what Vaibhav said, right? When we try to keep defining what a urban professional mean. So, for example, you mentioned, right, position a lot for urban professionals. You and me in my personal capacity, for example, right? Now, if you think about it, urban professional, see, today it's completely changed. But even in, let's say, a year and a half back, when before the COVID, if you're a urban professional in the city of Jaipur, right, and you're earning, let's say, lakh rupee or 2 lakh rupee a month, as an example, and same you're doing in Bombay, sure, your expenses could be more. But what we noticed is the good amount of traits you carry are pretty similar, right? Now, when I say pretty similar, at least to begin, then you have to obviously understand the risk appetite of the person. The person sitting in Bombay might be a person who is actually carrying a family of four, and person who is sitting in Jaipur might be a single individual who is happy to take 100% risk, for example, right? And their goals could be very different, and that drives a lot of these things, right? And remember, right, whenever you talk about new age investments, at least in the broad capacity, we are primarily talking about debt investments, right? With all the new age investments broadly falls under debt instruments, right, or debt allocation. In general, this category put up in their head, they put a category of a broad percentage for debt. Within that, they try to allocate some for alternatives, right? And it is definitely evolving, right? And from partners, from industry, I'm hearing people are happy to adopt in the cities of Surat, Baroda, Jaipur, whatnot, right? So it's not really about Bombay, Bangalore anymore. Sure, Bombay, Bangalore folks are like the classic, charge theory. They're always the early adopters because we are like, what some of these Bangalore folks like to be cool. They'll always like to know new things first. There is always a brag-worthy element to it, right? The moment you get to know about a new asset, you want to talk to 10 people about it. You want to brag about it, right? As an example. Sure, that's the case. But you know what? The spread is very fast happening in the, as you defined it, let's say tier two or whichever demographic, if you like.
Interesting point there. Gaurav, following up there, do you think regulators have a role to play here as well to create an increased awareness?
Uh, I think broadly, yes. See, what I think, and maybe I might be biased because I followed, let's say, P2P industry very closely. From 2013 to 18, right? It took significant time for them to, take any acceleration speed. Once RBI put their lens on it and put a regulation around, let's say anything, right? They put a stamp on it and they give them the, they are regulated, and then they increase the limits. A lot of that, suddenly you start seeing everybody starts getting that attention, right? And every industry in the beginning, I think, will go through that phase because, see, again, this is my reading of the general regulation. In the beginning, they don't care, right? In the beginning, they say, okay, what you're dealing with few hundred crores, so you really don't need to worry about it. You've got bigger problems to solve, and they continue to solve that. Once they start seeing the money, serious money has started moving in, they need to put some regulation around it. And the moment regulation is there, any sorts, right, and some certain sorts, it definitely gives the investor certain comfort. See, I don't know how much it helps, but it definitely gives me a comfort to say this is, let's say, RBI regulated, as an example.
No, I think that's a good point that it gives investors comfort because a lot of times, especially people who are creating these new products think that regulations essentially are roadblockers for them to scale. But from the investor side, I think it is much more important that it gives comfort to them because they say it's SEBI regulated or RBI regulated. That means okay, I am safe when
Right,
I'm investing there.
right,
So
right.
on the topic of SEBI, just thinking about most of these investment products are not even market linked. So, Vaibhav, what do you think as a advisor? What role do these products play in your asset allocation when you're giving them? What exactly do you want these products to do for your investors? Is it a hedging? Is it something like an alpha creator? What do you think? What is it?
So it depends on the kind of instrument that we are talking about, right? So when we are investing in digital currencies or we are investing in gold, we expect them to hedge our currency against any potential depreciation, right? When we are investing in unlisted equity, we are looking at some sort of insulation from markets and say that these are new businesses where we can look at high growth opportunities. When we are investing in real estate, we are looking at a combination of rental yield and price appreciation. Whereas when we are investing in product like yours, we are looking at short-term income opportunities. So depends on the kind of instrument that we are talking about. But obviously, all of these put together achieve a lot of different objectives, and depending on the investor's objective, we should allocate money. So for me, the core philosophy that drives allocation is what the investor's objectives are and his ability to tolerate volatility and risk, right? The maximum amount of loss in wealth management happens when clients are not able to hold on to their investments. So our entire focus is spent on, a lot of energy and time is spent on ensuring that investors are able to hold on to their investment till their desired holding period.
Gaurav, any take on that?
Yeah, I mean, see, it really depends on the portfolio, right? So if you are parking any of your investments in such assets for emergency, the answer is no, right? I mean, even I would go super conservative when it comes to emergency funds, right? Whether I know that's probably working against the inflation, but that's okay, right? Because the purpose is very different, right? But when it comes to short-term or medium-term broad goals, for some of I'm talking about more of the options, new age options, which are available to retail investors. I'm not commenting on large options which are very, very long in nature or cycle right now. But imagine if it's anything in short term and medium term, you've got interesting opportunities where you can think about a part of the allocation to go into, let's say, some curated peer-to-peer lending or the asset leasing like yours, or there are some interesting opportunities in this space is booming, right? This space is going to become very interesting. The space broadly starts with alternate ways of debt, and alternate ways of debt are emerging, right? Whether it's leasing, whether it's P2P, whether it's revenue financing and whatnot, right? Settlement financing and whatnot, right? So when people understand going back to the risk reward part of it and allocate a percentage to it, that's what makes it interesting. The important part to note is, and I've almost openly said it in one of the forums, I think in the grip session when we hold, right? One of the user got super excited to say, you know what, this looks great, right? I should put in all my money. This is where we can say, no matter how much you find, let's say, even the market linked opportunity is awesome, don't break your emergency fund, right? These are basic some principles to follow, and I'm sure Fenil, you also know from your background, right, that these are some of the principles to follow. If you follow them, you're good. The moment you try to break some of these fundamental principles, you are going to burn your hands, because that's where, as Vaibhav said, right, if you're not able to hold, let's say, a particular unlisted opportunity for a very long time because you have dipped into your emergency, it's not the problem of the investment, it's a problem of the risk you have taken, right? You should not have put in that money.
Yeah, no, I think 100% agree on that. And that's where I think an advisor comes into the play, right? Like, who advises you as to, how your asset allocation should really be and where should you park how much money. And it is very important in those terms that, those percentages are well defined and they are, followed in a very disciplined way. Which, brings on to an interesting question. And one of our viewers, also Dheeraj Bansal, has asked this question that, how do you choose the right product, right? If you can share a certain criteria with the people here, about on evaluating the new age investment products, it would be really nice.
So, Fenil, so typically the framework that we follow at Dezerv is we divide our investors' objectives in 4 parts. So first is protection of assets, right? So where Gaurav also spoke about keeping money in savings bank account, where that's your emergency pot of capital, which you can access anytime that you want, and you're not too worried about returns on that part of the capital, right? So I always recommend investors to take care of that first. Once you've taken care of that, then you move on to the next bucket, which is what we call market bucket. where we are focusing on listed securities, and listed securities could be a combination of fixed income, equity and debt, right? Fixed income, equity and gold. So once that is taken care of, then you move on to the next bucket where you look at aspirational assets like unlisted equity and high yielding debt, where you are looking at wealth creation opportunities. So first bucket is meant for protecting your wealth. Second is to ensure that you are able to do better than the markets. And third is for wealth creation. And last bucket, what we recommend investors is to diversify in currency and have some global exposure. So depending on what kind of objectives and which objective has higher priority in investors' mind, we allocate money across these four buckets.
Well, there must be some criteria, right? Like you be behind measuring the risk reward ratio, say, for example, a risk reward ratio, to measure these kind of investment products. So could you share some of those that you should look at this kind of information before investing into the new age products or non-traditional products, because there is literally a scarcity of information when it comes to these kind of products. So that's basically, I think, what even Dheeraj meant here.
So diligence framework is extremely important, Fanil. So you mentioned at the outset and before we got onto this call that right now your largest lessee has 10% allocation to the book, right? So when you are investing into these kind of opportunities, it's important that you diversify your risk. You don't want to take significant amount of tail risk by being invested in one single security or one single transaction. So this is an extremely important variable. Allocation discipline is extremely important. You don't want to over allocate money to a particular instrument or particular asset class. That's extremely important. It's important that you understand the security, your ability to enforce the security. It's important that you don't invest money where you need liquidity, because sometimes these investments can be extremely illiquid. And it's not to say that there's something wrong with the underlying investments, but if you go back in time, March 2020, best of the corporate bonds were illiquid, right? So these are some of the attributes and these are some of the parameters that every investor should consider and take help of the advisors in developing that structure or framework for management of your money.
Thank you, Vaibhav, on that. Gaurav would like to know your views on it as well, because I know Q per se is quite big on diversification. Whenever we've had a conversation, you talk a lot about diversification. So anything specific that you look at?
Yeah. No, so you're right, Fennel. I mean, to be honest, from Cube or even before Cube and how we started and how we started framing this, what we learned for sure is the diversification rule can't be broken at all at any point of time, and that has really helped us to understand and choose even the new age options, right? And one of the other thing is that Cube is also has always been big on at least adding some of these new age options. However, on the prima facie, it looks like we have got few options, but we screen many of them, right? Screen many of them, and that I think that was one of the question to understand that how do you pick these new age options, right? So sure, I mean, there's some broad framework, and I can't really do the justice as a quick answer, but a broad framework. It's important to understand that. It's important to understand that which kind of alternative investment first we are starting to talk about, right? If it's a straightforward something like a P2P lending as an example, see, it's by the license it's different, but as a structure it's the same old business, right? If you think about it, it's an NBFC. So first thing you need to know if any NBFC is what's their cost of capital and what's the gross XIRR they generate and the NPA they have. If you have these three numbers, you can do the maths, right? And if you just don't need to have the number as a one point of time, right? As a snapshot, you should have it over a period of time so that you can do the averages, you can figure it out, in a realistic sense and so on and so forth, right? That gives you a fair comfort of saying, is it worth going for that risk or not, right? And that framework, to be honest, has worked reasonably well for us. I mean, reasonably well for us, and maybe that has really helped us to continue to vouch for such options. Similarly, some of the other pointers which help is even if the options are new, you need to definitely focus a lot on the team, right? Founding team and things like that. See, that also says a lot, right? And whenever we speak to many of the other folks and we give it a pass for now, for sure, is because we want to idea to get matured. We really want to go through a particular cycle. We like to understand that what are the factors they have looked at. Are they really looking at financials? Are they looking at recovery? What kind of buffer which could be already be there. Sure, see, I to be honest, as an investor, I don't mind you give me 8% and you earn 20%, because what I want is you give me 8% for sure, right? As an example. So I every time I speak to somebody and whenever the people are hesitant to talk about their XRI, I tell them, you know what, the more you tell me, the more comfort you will give it to me. So that makes it really important, right? So these are some broad important parameters and factors which comes into play when you look at looking at these new age options. And there are some new age options which really have none of these metrics which apply, like crypto, right? As an example. So I really can't put any number to that. So, but yeah, that's a broad idea of how do we, go about it.
Interesting.
Yeah,
I
just
think
to add one more point for the benefit of the audience, unlike a conventional NBFC, these platforms don't have capital cushion. So, so that I think everyone should make a note of.
yeah, no, I think that's quite interesting. And what Gaurav also said, crypto doesn't really, there are no criteria to measure that. I think that's, that's quite interesting. Yeah, but sometimes it's also interesting to understand, like the underlying use cases of these cryptos, they are like quite fascinating. But yeah, I think steering away a bit, from non-traditional investment products and investment products in general. Vaibhav, with your heritage, I know that you were a part of the founding team for IIFL Wealth, and everybody knows where IIFL Wealth today is. It is one of the biggest, and now you've taken this path to entrepreneurship with Dezerv. What I would want to understand is, what essentially is the role of a financial advisor to an individual, and how do individuals perceive the financial advisor to be, because I believe there is a big disconnect. What are your thought process on that?
The disconnect comes because of the communication, Fanil. Okay, so if I look at my role and if I were to define it, I should play a role. I should play a bridge between investors' resources and their investment objectives, right? So that entire journey I should facilitate, right? From understanding investment objectives, their risk profile, the kind of instruments they will be comfortable with, understanding their liquidity requirements, taxation, so on and so forth. So in my mind, that is the role that we should play. And that's what we endeavor to do. Once an investor is there who has stated his objective, is looking at us to guide him through the process, I'm very, very happy to run that for them. From an investor's perspective, sometimes investors perceive us as someone who will bring in great product idea for wealth creation. But honestly, that's only one part of the activity that we do. And it's a subset of the larger activity that we do, which is trying to become a bridge between their resources and their aspiration.
I think that's quite interesting. Resources and aspiration, again, something that I'm going to take away with me. But yeah, Gaurav, what's your take on that?
Yeah. So, so your question was what's the role of the advisor in the mind of
Yeah,
investor?
both, right? Like what according to you should a financial advisor be playing a role for an investor, and what do investors actually perceive that what is the financial advisor actually doing, or what their role is?
Yeah, sure. I mean, yeah, both are both are good questions. So, see, in general, in India or a lot of different places, right, our awareness about personal finance is pretty poor, right? And even though it's one of the most important topic of the life, it's not taught, right? It's not taught anywhere, and it's very unfortunate, right? And sure, I'm hoping that it will improve over a period of time, and it really helps because once you are aware about something, you are more more little bit more inclined towards accepting an idea in that area, right? Otherwise, what happens is that every time you look at the advisor, you unfortunately try to see them almost as if you're looking at a salesman, right? Sometimes, right? And that's where the part of the relationship breaks a few times, and that's where I think the disconnect happens, and people create their own miseries in general. Now, but otherwise, if you look at it, see, I'm sure there are really, really good advisors out there, and there are good players out there. But unfortunate part is that we have all been gone through those uncles in our colonies of classic towns, and who come and will talk to you because you're in town, and give you some policy, right? Or which you will figure out over a period of time, saying, "What, I don't know what was that," right? And you, by the time you learn that it's what is ULIP or something, that you're already old and you are looking for that uncle, right? And that's really how we have grown and brought up, and that's how we start looking at it. And then that I really don't mind when people are a little skeptic to begin, and that's where our role starts, right? Because you tell them to educate them first, right? What is your role, right? As Vaibhav also said, you're basically trying to create that bridge. You can use different terminology. You are a coach, you are a probably a trainer for them. You are trying to help them to, it's really, you're trying to help them, right? If you think about it, we take a hardly any percentage of that, hardly, right? It's
Yeah.
really nothing if you try to compare it to any other industry in general, right? But the thing is that you try to work with them, help them to understand their goals. You try to dig them and really try to push them and say, you know what, show us, or probably write down whatever you are looking for, whatever you have, what are your aspirations, what do you really want to do. Sometimes we even do a reality check, right? People live in their dreams, and they say we want everything on the earth, but it's not possible for them, and you try to cut them for that, and so on and so forth. Now if you think about it, you take all this mess, you give the shape to this mess, and you give the next step of the direction, right? In my mind, it's a pretty beautiful work to do, but I hope this is generally conveyed and intended the right way across the industry, and that's where it will this will flourish a lot.
So I think your words, literally remind me of my first reporting manager. Would love to name him Amit Tripathi. He used to say that we wealth managers essentially should act like financial doctors. We need to take care of the financial health of the individual. So when you said training, coaching, it just reminded me of Amit. So yeah, I don't know if Amit is watching this, but yeah, kudos to Amit there for
Yeah.
sure.
No,
Uh,
there is excellent. Just thinking of another analogy that I use. We believe that we are doctors, and sometimes investors believe that we are a chemist shop.
Yeah, that's an interesting one, I think. This will be my quote of the day. This will be my quote of the day for sure. So yeah. Um, uh, sorry. Gaurav, on that point, considering the diverse offerings that you have on your platforms, how easy is it for you to, manage multiple products, their workflows on the platform or on the application?
Sorry, I didn't understand your question. As in, what do you mean by that?
Like essentially, like there are like diverse offerings that you have on your platforms, right? So how do you really manage the whole multi-product workflows under one roof, right? Like with so many products, how do you really essentially manage that thing under one roof?
I'll say, I'm telling you, if my any of my engineer team is hearing it, they'll be glad, right? It's tough, man. It's really tough. It's you can understand there are different industry standards, and everybody follows the standard. It's a lot of legwork which happens behind the scene to make it appear as if it's very simple, right? Everything you today or see on our app looks as if you're showing the data in a most simplest manner. But behind the scene, that's where the complication starts, because what we believe in is one of the key things we believe in is that if I am not able to represent the data to a layman, which layman can understand, I'm again not doing a right job, because otherwise again I'm using a jargon or a terminology for which they need somebody, and that's where again we are breaking that trust chain, because they're again now perplexed or worried if they should even venture into this. We want to make it simple. Sure, there are some complexities to that. There is no denying to that, but at least the data, the representation, the flow, the way you can behave, the way you can invest, the way you can redeem, and so on and so forth, that can be simple. Sure, you can talk to somebody to know more about a particular asset or about a portfolio. That's very different to comparing the flows, comparing the UX part of it, almost your UX, the experience of it, and representation of that in a pretty layman terms, honestly.
That's an interesting answer. Whether you're undergoing the developing phase, right? Like, so how are you trying to manage it? Because these are two different companies at two different stages. So, it's interesting to getting views of, both you and Gaurav here.
No, absolutely. So a lot of new investment ideas keep coming our way, but everything has to go through a rigorous filter process. And from our perspective, our focus is in ensuring that we do extremely deep due diligence on each of these investment ideas before we recommend them to the users, and make sure that only users who have utility for these instruments end up buying these instruments.
On that note, one question, for some of our NRI viewers here, any kind of advice for our NRI viewers, especially with the kind of currency fluctuation that we are seeing?
For inbound money, so for them to invest in India?
For them to invest in India, essentially.
Obviously, some of the investments and some of the instruments are not allowed for them, right? So investing into corporate bonds and some of these instruments are not allowed for them. So keeping that aside, they have to take care of their taxation part. Taxation can be steep depending on the jurisdiction in which you are staying currently. So that is something that one should watch out for. Currency depreciation, obviously, we work with an assumption that 3.5% depreciation will be there, but large part of that will be dependent on how inflation trajectory moves for both India as well as for the developed market. So keep an eye on that. And besides that, keep track of your tax expenses. Seen it can hurt significantly.
Yeah, I think tax expenses are quite difficult. Some places have a double taxation avoidance treaty, some don't. So I think that's very, very important there. Gaurav, any take from you, when it comes to NRI market?
Yeah. No, again, I'm honestly not a tax expert, but I know for a fact that it sometimes become hairy, right, at the taxation part. But again, depending on the kind of audience you're catering to, for example, we have a lot of these professionals who have, these, NRE, NRO accounts, and they have the option of at least taking some benefit of the capital which they can generate here, which is tax free, for example. And they usually have some expense or the other happening in India, so that at least that part gets covered in a smaller sum. It's not like in crores, but at least in few lakhs, for example. That really helps. And second important part is that there are certain set of RI investors we have who are bought into Indian story, right? And sure, they are completely aware, and that there is a currency depreciation which happens, and that I think, if I'm not wrong, it's more valid for currencies which is dollar, etc. Not really European currencies sometimes. Sure, there is a range to it, but that typically doesn't vary that much. But more than that, if they are sold to an Indian story, right, of something, for example, if we have investors who invested in via equity advisory or PMSs, and they like the story and they really want to generate, they believe that Indian markets would grow. They were still very small as compared to right, the larger markets, considering the size of the country. For example, we're still at sixth, and US contributes half the market globally, right, in general. And we know that we just started, as an example, and our country also, the penetration is low. So they believe that Indian story is there, the growth is coming up, and they understand these downsides, but they still want to invest from many of these options, and they want to play long for that.
Thank you, guys. On that note, I'm just going to open the floor for questions from our viewers. There is a question from Harsh. Harsh asks us that, what are the new age revenue generating models for advisors? Any of you, who would want to take a pick at it, please.
So revenue structure remains the same. From an advisor's perspective, if you are acting as an advisor, fee that you generate from investors is the only source of revenue that you have. You can receive it in form of brokerage or in commission or profit share on the PMS, but by and large, that's the only source of revenue which is there for advisors, if I have understood the question correctly.
Yeah, no, I think that's a fair point, and I believe Harsh was also looking at that. Gaurav, do you Looking at you smile, I think you have a couple of other answers
No, no,
also.
no. I was saying that I'm sure Vaibhav knows this pretty well. This is a pretty loaded question, to be honest, because the regulations are pretty tight in this industry, right? And everybody is aware of it. Nobody tries to figure any workarounds, to be honest, and we play with the rules. The part is that even with to play with the rules, it's a large market, right? So if you are offering mutual funds, you can get, let's say, a classic mutual fund distribution commission. And if you are offering any other asset class, the asset provider itself offers you certain, let's say, sales commission to offer it. You don't really charge the user to for that. So I think many of the products in general in the industry have baked in certain commission model, and I don't think we need to discover that. Sure, there will be layers on top of that, which could be premier membership models, etc., which we've also been trying as an example. But that's broadly this, again, as I said, right? It's fairly regulated market for that matter.
Thanks. And there is a broader question for both of you. It's by Koshi. Koshi asks us that how your wealth management is different from the existing players like Grow, IND Money, and what do you do differently or uniquely? So, would love both of you to share your thoughts on it. Vaibhav, do you want to start?
Yeah. So, from our perspective, some of our activities overlap and some of the activities don't overlap. So, both Grow and End Money's offerings are slightly different. Grow is largely a transaction platform where investors who are sure about what they want to do can go and get their transactions executed seamlessly. Uh, from whatever I have seen of Grow, I think it's more a transaction execution platform. Uh, from our perspective, Deserve is a platform where we are focusing on giving expert advice and curating a personalized solution for the investors depending on their investment objectives. We use extensive science and our expertise in developing these solutions for our investors. End Money also, in some sense, have a combination of execution platform and advisory platform. So that's what I've seen of them.
Gaurav, how about you? What is your view on that question?
Yeah, sure. See, Sunil, there is a wave one of investment apps in India, right? I almost bucket many of these, by the way, Grow, and there are many others which are, as Vaibhav also mentioned, they are more transactional apps and wave one apps. They have created, they've done a good job of creating awareness about investment options, penetration, and so on and so forth, right? And they've gone, across cities and towns to get the investments in, right, or transactions in. However, if if you go back to the problems which we mentioned few times, right, it's not really the problem only of discovery. It's also the problem of combining these discovery in the right manner, which is relevant for you. Unfortunately, and I might be wrong, trust me, 95% people don't know that. Okay. If 5% people know that, it's great. They can do that. And sorry, Fenil, are you there?
Gaurav, you're audible. You should go ahead.
Oh, sorry. I thought he got first. Sorry. Yeah. So as I said, right, 95% of the people, in my opinion, they don't really know how to build a portfolio for them. And sure, 5% people know, and they should definitely go figure out direct models and these transactional apps do their own. But we really want to solve the problem for the rest of the 95% of the urban professionals. They need handholding in certain manner to build a portfolio, what we call a perfect portfolio, in which we ensure that we curate investment options. By curation, Cube Wealth really means that each investment, and Nikhil can probably, and the grip team can vouch for that, each investment we personally put our money in first, right? And that becomes one of the key curation layer. And then on top of that, we build a perfect portfolio which caters to your short-term, medium-term, long-term needs to ensure a portfolio which is relevant for you, the combination of all these assets. We are, to be honest, I would mention is we are happy to see Dezerv taking that position because, unfortunately, it's like wave one, right? As I said, said, wave one, not many people taken this position of portfolio creation. Now, Dezerv also taken the position of creating a portfolio creation. It creates awareness, right? It really helps, to be honest, us also of to educating people that the part of the problem is not finding out the asset only. It's part of the problem also lies in ensuring what's right for you. It's like a diet, right? Not everything is right for everyone, right? And what quantity. So that's the role we play.
Oh, no, those were like really two very, very interesting perspectives. Thank you, Gaurav and Vaibhav, for it. I think I'll just take one last question from Vizen. What Viz is asking is, what is the expected return for a diversified investment portfolio for a moderate risk investor? Like, just to set the expectations right, if both of you can just give us a ballpark figure or a range, it would be interesting there. And there are a couple of other questions. I guess like we'll answer them separately, through an email or something like that, guys. So just in the interest of time, we'll just keep this one to the last question.
So moderate portfolio, a reasonable return expectation should be in the region of 9 to 10%. So I'll break down this 9 to 10% for everyone's benefits. So typical fixed income allocation, when we are talking about 100% AAA kind of allocation with a maturity of 5 to 6 years, we can expect 5.5 to 6% kind of returns there, right? So if 40 to 50% of your portfolio goes there, you should expect 3.5% return from this part of the portfolio. Second part of the portfolio where you're investing in growth assets. So let's take equity as an example. There you should expect 12 to 14% kind of returns. So if you are allocating 50% money there, then you should expect 6 to 7% contribution to the portfolio returns from that part of the portfolio. So on an aggregate level, we are talking about 9 to 10% returns for a moderate risk portfolio.
Yeah, that's quite fair and quite straightforward calculation. So thank you on that. Gaurav, your take?
I think it also depends a lot on time frame, right? The world we are living in has fortunately set a unrealistic expectation for a lot of people. So where Nifty itself might have, let's say, delivered a 20% CAGR in the last 2 years, for example, broadly, it set the expectation, this is what I can expect. But if you think about it, conservative advisor, right, always tells you to expect 8-ish% on your debt in good times and 12-13% in your equity portfolio, right? And then these are always conservative calculations, and you, as and when how we are building the portfolio, you can do a blend of it. Now, sure, it could be the part of the result of how we have seen the portfolios growing because we have completed 3 years. Some of the good portfolios have delivered. When Nifty have delivered 20, they must have delivered 30+% as an example. And sure, as you can see, the number itself represents that they must be the part of the aggressive portfolio. But if you think about the moderate portfolios, they have the lower allocation to equities, and hence their portfolio comes very close to what, let's say, Nifty returns could be, right? But again, this is a very time frame question, but in a realistic sense, you have to trim down your expectation based on what the time frame you are broadly looking at.
Thank you so much, Vaibhav and Gaurav, once again, for taking the time out here and, sharing your insights. I believe all your answers were very, very insightful, and to all the viewers that are listening, if there are any other questions, please feel free to, write an email to us and we'll try and answer them in the fastest way possible. And yeah, I guess Vaibhav, wish you all the best for the soft launch next week.
Thanks.
To share the invites with us as well. And, and all of us are in Mumbai. We should try and catch up sometime soon.
Yeah. Sure, definitely.